Good morning, everyone. Welcome to the May 6th edition of Market Opening Bell, your 10-minute guide to the stock market. Overnight, U.S. stocks were affected by news of U.S.-Iran clashes in the Persian Gulf, causing Hong Kong stocks to fall. The Hang Seng Index opened 150 points lower, later dropped as much as 405 points to a low of 25,690, then narrowed losses in the afternoon to close at 25,898. down 197 points or 0.8%. The A-share index closed at 8,730, down 43 points or 0.5%. The Hang Seng Tech Index closed at 4,929, down 47 points or 0.9%. The Mainland May first holiday meant Stock Connect was suspended with total market turnover at 122.2 billion Hong Kong dollars. The Hang Seng Index once again fell below the 26,000 mark and even briefly broke below the 50-day moving average at 25,803 points. It is expected to continue fluctuating in a narrow range around the 26,000 level in the near term, remaining in a consolidation and wait-and-see pattern. The renminbi central parity rate against the US dollar was lowered by 20 pips to 6.8628 per US dollar. US and Chinese leaders are scheduled to meet in Beijing next week. US President Trump said he's very much looking forward to meeting Chinese President Xi Jinping, describing the summit as highly significant for both countries. The two sides will seek to discuss trade issues and the Iran conflict. US and Chinese officials have been preparing for this summit for months, including discussions on establishing new bilateral mechanisms to better manage economic relations. CK Hutchison rose 4.1% against the market trend. The company announced the sale of its entire 49% stake in the UK telecoms joint venture, VodafoneThree. The deal is expected to complete in the second half of 2026, subject to regulatory approvals. CK Hutchison will receive £4.3 billion, approximately 45.494 billion Hong Kong dollars in cash. The group expects to record a disposal gain of approximately 4.7 billion Hong Kong dollars. According to CK Hutchison, the transaction monetizes the investment at an attractive valuation and aligns with the group's asset-light strategy. In recent years, CK Hutchison has frequently sold mature assets in Europe and the UK, such as UK Power Networks, to strengthen its balance sheet and redeploy capital into higher return opportunities. The substantial cash inflow will help support future dividend levels or share buybacks to reward shareholders. CATL rose 3.7% against the market. Investment banks expect CATL's next generation sodium-ion and condensed matter batteries to be rapidly scaled up, driving faster earnings growth and continued market share gains over the next 3 years. Sodium-ion batteries offer low cost and excellent low temperature performance, making them an important complement to lithium batteries. CATL has resolved key manufacturing bottlenecks such as hard carbon gas generation and plans to start large-scale production in 2026. Its new Nextra sodium battery brand has achieved an energy density of 175 watt-hour per kilogram and has passed Chinese national standards. Cell cost is expected to be about 30% lower than LFP. At scale, pack level cost is projected to fall to 40 to 45 US dollars per kilowatt hour, with a range of up to 500 kilometers, ideal for small cars priced under 100,000 yuan. Its ability to retain 90% capacity at minus 40 degrees Celsius gives it strong competitiveness in cold region energy storage and commercial vehicles. Sodium batteries are forecast to reach 20 to 30% penetration in China's new energy vehicle market by 2030. Condensed matter batteries use high performance biometric biomimetic condensed matter electrolytes to balance high energy density and high safety, targeting the premium segment. Cell energy density reaches 500 watt-hour per kg and has already powered the maiden flight of a 4-ton commercial electric aircraft. In passenger vehicles, the mass production version offers 350 watt-hour per kg, enabling sedans to exceed 1,500 kilometer range and full-size SUVs over 1,000 kilometers. The liquid-free design completely eliminates leakage and fire risks, meeting the strict safety standards of aviation and luxury cars. Brands such as Porsche, Land Rover, and NIO have expressed interest in cooperation. Annual potential demand in China and the EU luxury car markets is expected at 200 to 300 gigawatt-hour. Thanks to high technical barriers and low price sensitivity, these premium products will effectively avoid low-end price wars and significantly improve the company's overall profit margins. Wind power stocks in Hong Kong fell sharply yesterday. On the news front, the Trump administration has halted U.S. onshore wind power project development, citing national security concerns, directly reducing potential orders for wind turbines, blades, towers, and other core equipment. With the U.S. market blocked, Chinese power equipment companies will shift focus to the domestic market. Although China's domestic wind power installed capacity continues to grow, exceeding 600 gigawatt by end 2025, overexpansion has already led to losses and signs of overcapacity. Chinese companies will therefore need to strengthen their presence in Southeast Asia, Central Asia, and the Middle East, or seek breakthroughs in offshore wind power, an area not yet fully blocked by Trump's policies. HSBC released its Q1 results. Reported profit before tax was $9.376 billion, down 1.1% year-on-year, slightly below market expectations. The main reason was a 48% surge in expected credit losses to $1.3 billion, higher than anticipated, including about $600 million in one-off costs and high provisions. Earnings per EPS was significantly below some analysts' forecast of $2.14. Revenue rose 6% to $18.62 billion, slightly beating expectations of $18.53 billion, driven by strong wealth management and Hong Kong performance. An annualized return on tangible equity reached 18.7%. Excluding major items, the highest in nearly 20 years. The board approved the first interim dividend of $0.1 per share, unchanged from last year. HSBC did not announce a new share buyback this quarter. Management said it will first restore the CET1 capital ratio to the 14 to 14.5% target range before considering restarting buybacks. HSBC shares accelerated losses in the afternoon and closed at the day's low of $136, down 5.16%. In the results, HSBC mentioned it had conducted stress tests including the Middle East conflict. In a severe scenario, profit before tax could be hit by a mid to high single-digit percentage. Management remains confident of achieving a full-year ROTE of 17% or higher, supported by prepared contingency plans. Due to uncertainties, HSBC raised its full-year ECL ratio guidance to 0.45%. The group believes Hong Kong commercial real estate asset quality has stabilized, with almost zero impairment in Q1. If the Middle East conflict persists long-term, HSBC has multiple response options, including reducing risk exposure, increasing investment in low-risk business, and further strict cost control to push core ROTE to 17% or above. Budweiser Brewing Company APAC Budweiser Brewing Company APAC announced its Q1 results. The performance shows slight declines in revenue and profit, flat volume, strong India, China stabilizing. Net profit beat market expectations. Q1 volume was 1.974 billion litres, down 0.2% year-on-year. Strong performance in India and improvement in China were partly offset by shipment timing differences in South Korea. Revenue fell 0.7% to $1.493 billion, with revenue per hectoliter down 0.8%. Normalized EBITDA fell 4.5% to $463 million due to higher investments and lower other operating income. Gross margin improved to 51.1%, while profit margin contracted to 31%. Normalized profit attributable to equity holders was $234 million, almost flat compared with $235 million in Q1 2025. China volume declined 1.5%, but the decline continued to narrow versus the second half of 2025. Revenue fell 4% as the company increased commercial investments to support distributors and promote new products such as Budweiser, Black Gold, and Harbin 1900. India delivered double-digit growth and double-digit volume and revenue growth, with continued expansion in premium and super premium segments and rising market share. South Korea saw low double-digit volume decline due to high prior year base and shipment timing, but revenue per hectoliter still grew in low single digits thanks to revenue management strategies. Group CEO and co-chairman Cheng Yan-jun said that thanks to India's continued strong momentum, total volume has returned to positive growth. Investments in China are gradually showing results with narrowing volume declines. The company remains committed to expanding on-trade channels, enriching the product portfolio, and driving flagship brand innovation to rebuild growth momentum. Market share in both on-trade and off-trade channels continue to grow in South Korea. Plover Medical Technologies, stock code 1187, which will be listed today, closed at 40.02 Hong Kong dollars in yesterday's grey market trading on Philip Mart, 1.8% or 0.69 Hong Kong dollars above the listing price. Excluding fees, each bought lot shows a paper profit of $60. Plover Medical was founded in 2007. Its product portfolio covers over 200 categories and tens of thousands of SKUs. It owns 11 proprietary brands and mainly distributes 15 third-party brands. The company strategically focuses on 5 categories of home medical devices with strong growth potential and significant market demand, namely rehabilitation aids, medical nursing products, health monitoring, respiratory support, and TCM, physiotherapy, and others. In 2024, it ranked number 1 in China's rehabilitation aids segment by domestic revenue, with a 2.4% market share. Oil prices fell back while the Nasdaq and S&P 500 indexes reached new all-time highs on Tuesday. The Nasdaq rose 1% to 25,326 points. The S&P 500 climbed 0.8% to 7,259 points, and the Dow Jones rose 0.7% to 49,298 points. The Fear Gauge Fixed Index dropped 0.91 points or 5% to 17.38. The Nasdaq Golden Dragon China Index, which tracks Chinese stocks listed in the US, rose 8 points or 0.1% to close at 6,889 points. All sectors closed in positive territory, led by material stocks, followed by technology stocks. Intel surged 12.9% after reports emerged that Apple is evaluating Intel and Samsung Electronics as potential secondary chip foundry partners, in addition to its long-term partner TSMC. Apple has reportedly held early-stage discussions with Intel. Apple executives have also visited Samsung's advanced chip fab under construction in Texas. However, negotiations with both companies are still in the early phase and no orders have been confirmed. Micron Technology rose 11%, Apple gained 2.7%, and Cisco Systems climbed 1.8%. AMD reported better than expected first quarter results, driven by strong demand for AI infrastructure, boosting data center revenue. Adjusted earnings per share rose from $0.96 a year ago to $1.37, beating expectations of $1.29. Revenue jumped 38% year-on-year to $10.25 billion, exceeding the consensus estimate of $9.9 billion. The company guided second quarter revenue to $11.2 billion, well above the market consensus of $10.54 billion. Pfizer beat market expectations in the first quarter as strong demand for its key brands offset weaker sales of COVID products. The company reaffirmed its full-year guidance. Adjusted earnings per share fell from $0.92 a year earlier to $0.75, but still topped expectations of $0.72. Revenue rose 5% to $14.45 billion, beating estimates of $13.84 billion. Pfizer maintained its full-year adjusted earnings per share guidance of $2.80 to $3 and revenue guidance of $59.5 to $62.5 billion. Pinterest reported first quarter revenue up 18% year-on-year to $1.01 billion, beating expectations of $967.2 million. The stock rose 6.8%. The company expects current quarter revenue between $1.13 billion and $1.15 billion, up 14 to 16% year-on-year, in line with the consensus of $1.14 billion. Adjusted earnings per share increased from $0.23 to $0.27, matching expectations. Monthly active users grew 11% to 631 million. Average revenue per user rose 6% year-on-year. The U.S. Bureau of Labor Statistics reported that job openings in March fell slightly from 6.92 million in February to 6.86 million, marginally above expectations of 6.85 million. The job openings rate stood at 4.1% and of total improvement, down from 4.2% in both February and the same period last year. Hiring rose from 4.89 million to 5.55 million, pushing the hiring rate up from 3.1% to 3.5%. The U.S. Institute for Supply Management Services Index for April fell to 53.6 from 54 in March, slightly below expectations of 53.7. Output and unemployed indexes rose while new orders and inventories declined. The prices paid index remained unchanged. S&P Global's U.S. Services PMI was revised down from the flash reading of 51.3 to 51, but still higher than March's 49.8, indicating continued expansion. S&P Global noted that weak demand led to lower sales, while remaining While rising inflation and the Middle East conflict increased uncertainty, employment edged higher, and business conditions is improved. Our stock pick today is Plover Bay Technologies, stock code 1523. Plover Bay Technologies' core business is the design, development, and sale of connectivity solutions, including routers, accessories, software licenses, warranty, and support services. For groups currently offered connectivity solutions cover self-developed routers, switches, and software service platforms, antenna subsystems, network adapters, wireless access points, SIM card injectors, and other accessories. At the same time, the group also sells Starlink satellite equipment. The group's business coverage includes North America, including the United States, Canada, Colombia, Mexico, Puerto Rico, and the U.S. Virgin Islands, Europe, the Middle East and Africa, Asia, and other regions. The group serves an extremely long-tail market with thousands of customers spanning dozens of vertical industries: maritime, transportation, public safety, construction, mining, agriculture, event planning, retail, enterprise branch offices, autonomous vehicles, live streaming, RVs, mobile living, education, healthcare, and more. No single customer or industry dominates. The group is neither a pure hardware company and a SaaS company, nor a SaaS company, but something in between. The group continuously improves its products and supports its partners. What it sells is not generic hardware, but products designed for specific uses and application scenarios. Customers choose the group because of the product's functionality, not just price. This gives the group pricing resilience that typical hardware vendors lack. Unlike SaaS companies, the group does not need to invest heavily in acquiring customer subscriptions because its hardware is already installed in customers' networks and working every day. This large installed base is the cornerstone of its subscription business. The group plans to spin off its North American business through a distribution in specie to eligible shareholders, followed by an independent listing of the spin-off business on Nasdaq. The logic is currently more than 58% of revenue comes from North America, and that market has its own unique rhythm, including customer expectations, competitive landscape, and pace of innovation. At the same time, Europe, the Middle East, and Africa, as well as Asia, offer substantial growth opportunities that require different operating strategies, partnerships, and localized presence. Splitting the two means both sides can focus fully. One side completely dedicated to the North American market and listed on Nasdaq, while Plover Bay Technologies focuses on the rest of the world, leveraging the broader Asian supply chain, including advanced manufacturing, efficient logistics, and highly competitive component sourcing. Suggested buy price $8, target price $8.80, stop loss and $1.60. I do not hold the above stocks.